And I don't have a single startup that's gotten past their B round without getting money from outside Europe. And that's just crazy.
Years ago, this man was my boss, Deloitte. I was the consultant and he was the partner. Andy Goldstein has spent 40 years building up the machine behind German tech. He co-founded the German Accelerator, the LMU Entrepreneurship Center, Deloitte Digital Venture, 1,500 founders, 9 unicorns, Celonis, Flixbus, Trade Republic. He was in the room very early. And now in Munich, he's building Venture University because his bet is that Europe doesn't lack great startups, it lacks great investors, 10,000 of them. And today we have him here on the podcast, the whole story, the mission, the model, and the man who taught me a thing or two.
Literally across the planet, less than 25% of all venture capital funds ever return more than 1 times the money.
Do you think it's too late to buy shares from SpaceX?
Can unfortunately list a lot of unicorns that I could have been in and I didn't. You really have to let them know that there's high 90% chance that they're never going to see the money again.
And to everyone who is listening to this episode, please make sure to hit that subscribe button. The project is still new and my team and I, we would appreciate any support on this. Thank you very much and let's get started. It's wonderful to have you here today. For me, it's something like a full circle moment because I want to give the audience some context here. Andy was actually my former boss at Deloitte when I was still a consultant, and now we are sitting here and we will talk about startups, about investing and capital raising. And there is one thing that I always wanted to tell you because I think you are actually a great networker. Like you follow up on WhatsApp, you invite me to events in Munich, and I like this so much. So my first question to you is, do you think that investing in startups is deeply connected to networking? Is networking the one most important skill for investing in companies?
Well, I do think you need deal flow. There's lots of ways to get deal flow. It doesn't have to come from networking. I'm a strong believer in serendipity, like giving life a chance to reveal itself to you in a positive way. And so when you network, that happens. And, I was on the phone this morning with Andy Harding, and he's joined the board of a new company called Net Symphony. And now, I said, I ought to connect you with a CIO. And just because we're chatting about when we're going to go swimming next, right? So that's the kind of thing that happens. And when you're out networking, it's just about enjoying. If you enjoy being with people and you enjoy learning about people, it's very easy to be a good networker.
I also really try to do that very often because I also believe networking helps in every situation, not only for fundraising, but of course for fundraising and capital raising. It's definitely also super helpful. Now, my next question is more related to pitches that you hear sometimes. Is there like one buzzword or anything that you see very often right now in pitches where you think, oh, not again this buzzword?
Well, I don't know if I say, oh, not again, but I do hear it all the time right now, especially from software companies, which is we're an AI first company. And I think there's a reason for it. There's been this SaaSpocalypse where people are starting to feel like programming has gone digital because of AI, and therefore we all remember what happened when photography went digital. Things go digital, the price of it goes to zero. So people are concerned that the companies that are programming and doing software development, that it's going to be able to be completely replaced. So they have to say they're AI first. But the reality is everybody's saying AI first, but very few companies really are AI first.
So what would you then suggest to these companies? Basically not saying AI first?
I think AI first is like on 15 different levels, right? It goes from your people all the way to your technology. And so I think if you're going to claim AI first, then you have to really understand, who your large language model partners are, what your agentic strategy is, how you're putting it into your client approaches. You have to be able to show an investor that you're not just saying AI first. You have to be able to show that these are the different levels of my company, and AI is on every one. Then you become believable.
Yeah, understood. That makes sense. And now I also saw in my research you have invested in 9 unicorns. I would love to understand better if, like, what feels obvious when you spoke to them like the first time, what was like the signal where you thought, okay, I have to be part of this now?
Well, there's different levels of that. So, I ran the LMU Entrepreneurship Center for 16 years, and I started and co-founded the German Accelerator, and we've had a lot of unicorns come through there. I do remember when the Flixbus guys walked into my office years ago, and, at the end of the pitch, I said, so you're basically in PowerPoint mode and this is all theory. The laws haven't changed yet. And they said, no, it's all theory. And yeah, we're in PowerPoint mode. And I said, well, you know what? You're in, let's give it a shot. I think you see there's somebody who's talking about something that you've never heard before. Or if you understand it, you've never heard about it in that manner. And you look in their eyes and they are burning on fire for it. And you know that they're simply not going to stop until they make it work. Does that necessarily make them a unicorn? I don't know. We'll talk in a bit about our fund now, Venture University View Venture Partners. We've invested in unicorns. We've tended to invest at later stages. So, sometimes you can understand that somebody's on track to be a unicorn, and a bigger mistake would be not to invest in that company because it's pretty clear they're going there. It's pretty clear they're going to make it. The question is, how far do you believe they're going to go? So I think, the early stage thing is about the burning entrepreneur, and the later stage is about traction and execution.
And how do you know if someone has like a burning attitude? Like, is it asking a couple of questions, or is it more when you speak to them and you just feel like the energy about like what they speak about?
You definitely don't know. Yeah, I would say that I want to be blown away by the founders that I invest in. And I know when I feel like I'm blown away, and I know a certain energy when I feel it. I've invested in lots of companies who I thought had that energy, and they're not here anymore.
Oh.
Yeah, so it's not there's really no formula, but I think that it's somebody, you want to really understand the clarity of their vision. It's not so much about their experience in the early stage. In fact, experience is often exactly what you don't want. People who know how an industry works are rarely the ones that disrupt it. But you want clarity on why they're doing it, how they're doing it. You want to understand, is there depth to the team, that they understand the size of the problem that they're tackling, and you want to understand that if they in fact do create this incredible breakthrough, that the market itself is big enough to make them into a wildly successful company.
That's amazing advice. And before we go deeper and speak now about capital raising, I would speak a little bit more now about your own background. And I would like to go a little bit back, like 40 years ago, and it would be amazing if you can tell us more about your journey, how you also ended up here in Munich, because I think you had a lot of steps in between as well. And then we will focus a little bit more later on Venture University, of course, and also investing and building companies.
Absolutely. So I'm a Philly boy, born in Philadelphia, raised there, was accepted into the University of Pennsylvania. I thought my life was made. I was, in an Ivy League school. About 2 years in, I decided to switch into the Wharton Business School there. I wanted to do business. I studied entrepreneurship and international business. I couldn't find anyone at 22 to hire me to run their international business, despite my incredible bachelor's degree. And my college roommate and I, the IBM PC was launching. It was 1983. I know most of the people watching or listening to this probably weren't born, but we saw that there was going to be a big market for software. We figured the Americans were going to be ahead in that area and that the Europeans would be a little bit behind. We decided to license US software and take it to Europe, and Germany was the biggest market for translated software. And in 1983, I picked up and moved actually to Vienna first. My dad and mom had a ski instructor friend who had become a successful attorney. He gave me an apartment and a car for a couple of weeks. And once I stopped skiing, we got the company up and running. Moved to Munich around 2.5 years later, because that's where the market was, and kind of never turned back from there. And I fell in love with Europe. I also fell in love here. And
That's amazing.
At one point you don't want to go back.
I love the story. That's super cool. And I also saw you sold the one company, right? So the one that you just described with the software. For my research, I saw that you sold it back to a public buyer in 2003.
No, so the story is the first company was called North American Software. That one I actually took me 14 years to pay the family, friends, and fools back 2-to-1, which I did. I was very persistent. Paid everybody back, knew what I was doing at that point. It was 14 years later. I spoke German quite well. I had great connections. The internet was taking off. I started a second company by myself called Media Gold in 97. My first partner and I think this is important, are still ski buddies. So, I think relationships and long-term relationships are important. Second company, I took a partner in England in 98. She and I took over a French company in 99. And that company we sold in 2003 to a French public company. Yeah.
And you just mentioned family and friends. And this is always a topic I have questions about, because I have the feeling when I speak to my US-based mandates and clients, they often raise family and friends rounds before they go institutional. And I think it's a great concept. Like, it definitely makes sense. But I was always just wondering, because if I then speak to German people, German companies, they rarely do the same. So do you see it the same way? Is it like a mindset difference between Germans and US people, that you go to family and friends to get first funding? Or do you also know that this is like a common concept here from your experience?
I think it's pretty common here. I see a lot of people going out and doing friends rounds, and seed stage is very often, whether you want to call it seed or you want to call it family and friends, it's very often the case. I think you just have to, I think when you're starting out and you do go take money from family and friends, or family, friends, and fools, as it's called, you really have to let them know that there's a high 90% chance that they're never going to see the money again. And that you don't want it to get in the way of the friendship, and you don't want to get it in the way of and that they shouldn't invest. If they absolutely need the money back, they shouldn't invest, because statistically they won't get it. Yeah. You're highly committed to it. You're going to dedicate your life to making sure that they make 10 or 100 times that. And that's why they should take the risk, or they want to. But you need to be real clear about that, because the statistics are not in your favor.
Like some years ago when I started spectup, as you know, I bootstrapped the company as well. It's just like a capital advisory, so I was not really dependent on taking outside money. But after some years then, when I got my first clients and I became a little bit more successful, my parents asked me if they can invest. And I'm still not sure if it was more like a joke or if they wanted to do it seriously. But I think they also saw, okay, he's really bringing some first clients, he's building the company. But this is again like a mindset thing, I guess, because I was not feeling that comfortable with that. Like when they said that, I immediately said no, because I don't want to have that additional pressure that my parents spend their money, their savings on me, and I don't know what will happen in the next couple of years. With AI and everything what is happening, I always have in my brain that there are threats for me, and I am not sure if the company will survive this or that. And that is like the reason why I, for example, would rarely take family and friends money in the beginning. I just don't like the feeling.
And I think you have to be true to yourself. It goes both ways. You have to tell them that if they're going to invest, that statistically they'll lose the money, and you have to then be comfortable with them losing the money. Part of the reason that I did take the whole 14 years was because I also wasn't so comfortable in not paying them back, and I just kept going and eventually did pay everybody back 2-to-1. 14 years, 2-to-1 is not so great, but I learned a lot. I felt like, and I've always been happy and proud that I did that. So it is a real emotional decision to take money from family and friends.
Let's now go a little bit back again to your experience. So you mentioned you arrived in Munich after Vienna, and you spent 2 decades basically building up the German startup ecosystem. You built up the LMU Entrepreneurship Center. You worked at the German Accelerator. What happened in between? Like, is there anything remarkable that you can still remember in that time? And how did you actually get started on these two things?
So I sold the company, Media Gold, in 2003 to this French public company. I was already teaching at the university, so my first $10,000 that I got when back in '83 came from my entrepreneurship professor at Wharton, Miles Bass. And part of the deal was I had to come back every year and lecture about the miseries of being an entrepreneur. And since there were plenty, I became a very good lecturer. And I mentioned to a professor that I met, a guy named Dietmar Harhoff, that I was teaching at Wharton. And he said, why don't you come teach at the LMU? So I started a class at the LMU shortly after I sold the company. And in 2007, they had run out of money. A guy named Rolf Dienst, one of probably the godfather of venture capital in Germany, had given Professor Harhoff $500,000. And he had built a great curriculum of courses, but they never quite got to building a center. And they had $100K left, and they said, let's find an entrepreneur who will give them the $100K and let him give him 10% of what he raises. And I was hanging around the halls because I was teaching, and they asked me if I would be interested, and I said yes, but I only would do it for free because I was running this public company. And it's amazing how quickly you get jobs when you offer to do them for free. So I became the head of the Entrepreneurship Center at the LMU, and about 4 years in, the government was also looking to set up an accelerator program. I started or co-founded the German Accelerator there. So it was sort of one thing led to the other, and I started the accelerator back in 2008. Nobody had heard of an accelerator. A lot of people couldn't pronounce startup very well in German. I just told a bunch of my best students to come sit in the office, and we got the accelerator started, and before you know it, the word spread that there was people who were really helping startups there, and from there it just went straight up. And the German Accelerator was a great funding from the German government, and that company now, which ran that, we started the way we funded the LMU back then was I started a consulting company which was called German Entrepreneurship. That did consulting, paid money to the university to run the center. That company is now called the Start 2 Group. Mm-hmm. I ran that co-ran that for almost 17 years, stepped out about 2 years ago to work with my son. And that company is now in about 9 countries. So I also started the Social Entrepreneurship Academy with Klaus Seiler and Bernhard Katze and Helmut Schönenberger.
So you started this one recently, or?
No, that's 15 years ago.
Okay.
And that's still running. So one of the things about me is the things I get started, they work.
That's amazing.
They sometimes take a little longer than I would like, but I focus on creating value. I don't like doing business when I'm not doing good. I've never managed to be just in it for the money. It's not my DNA. So I'm looking to contribute, and somehow my life philosophy is that what comes around goes around, and do good things, and you have healthy children, and you're successful in the end. So
that's super impressive. And I think one thing that I now feel about your experience is also that it seems that you are at the right time, at the right location, because you mentioned the software company, perfect timing to start software, then startups in Germany. Many years ago, you also just previously mentioned people didn't even know how to say startup. And now I have the feeling there is such a huge hype in startups, in venture capital, and in investing. And now you work on Venture University, basically training the next investors for the next generation. So from what you tell me, it always sounds like you are exactly doing the right thing at the right moment. Is it something that you do on purpose, or is it really coming naturally to you?
Well, let's put things in context, first of all. After 30 years, I became an overnight success, right? So it took me 20 years to sell my first company. And so I don't know if it was always the right place at the right time. My dad had a great saying, which I believe is something that everybody can really benefit by. He used to say, or I like to say, if you follow your heart and use your heart as your compass, you'll enjoy the path. What he said was, if you do the right thing, meaning what you know in your heart is right, if you do the right thing all the time, sooner or later you'll be doing the right thing at the right time. And I think that's more accurately describes what I'm doing. I think that for me right now, I spent 18 years building the startup ecosystem. There are a lot of great programs. It's not that I'm not needed, it's just that I think there's a lot of people out there doing a great job and I can move on. And what I've seen again and again and again in Europe especially is that we just don't have the investor base. We're now in the situation where we have great startups, but we're unfortunately in the case that I have a very large portfolio of startup investments, and I don't have a single startup that's gotten past their B round without getting money from outside Europe. And that's just crazy. And that's a lot because investors are not clear on how to invest.
And this is actually also a number I found when I did some more research on you and what you post public. So I saw that you wrote something about Europe that only invests around 45 billion a year in venture. And in the US, it's over $1 trillion. I also validated these numbers. They are right. But how would you explain the gap? What is the difference between these markets?
So I think that, now especially having, spent 2 years with Venture University, which is a VC fund, and you're inside of a VC fund. So, I spent a lot of time on the angel side of things. I hadn't really looked at VC, but one of the things that I see very clearly right now is that I do believe that the good funds are much more stage agnostic in the US. So you hear about, Andreessen Horowitz will put a 50K or 100K ticket into an early company because they're excited about it, and they'll be able to stay in all the way through to an IPO. European fundraising tends to be much more siloed. It's much more, we're too late for that deal. We only do A rounds or we only do seed, and if the valuation is too high and we can't have a certain percentage of the company, then we're not going to invest. I'm not impressed by that thinking. I think it's much more a value thinking. I'd rather invest a couple million in a company that's valued at 2 billion that I think is very, very likely to go to 30 or 100 billion than I would to invest in a company at, 2 million that I think might go to 10, right? So it's not so much about the stage, it's about really understanding a company is where they are when you meet them.
Yeah.
If you believe in that company and you see their traction, you understand where they're going, then I think you can make a good decision about whether or not you should invest, regardless of the stage that they're at. And I think that this is something that needs to be understood a lot better by European investors.
This is now getting super interesting. And I see it the same way, but I'm just wondering, what is then the reasoning or explanation for these European investors? Why do they focus so much on certain industries?
I don't have any issue with people's thesis about an industry. You're a healthcare fund or you're a space fund. I think that's all fine. I think it's more a question of the stage thinking. And I think that there's a lot of, thinking that, okay, if I don't have as a VC a certain amount or a certain percentage of a company, it's not worth it for me to be in, and therefore I can't deploy capital into that. Whereas I think that it's more a question of, are you committed as a investor to the long run of the company that you're part of, in which case you need to be able to, stay in. Another thing is, I think that not enough investors, and I don't want to say all Americans do know how to do this, because it's simply not true. Literally across the planet, less than 25% of all venture capital funds ever return more than 1 times the money. So I think venture capital is broken from a learning perspective. That's part of the reason for Venture University. But, it is the case that you do have to be ready to understand, I'm going to be in this company and I'm going to support this company. And that also means bringing in more money, right? The job of a lead is to raise money. I'm not sure that everybody understands that.
But do you also think sometimes that what European investors do in regards to these stages, for me, it sometimes sounds now a little bit like old school, because if we now look at the latest IPOs or what is coming in the next years, the potential exit potential for some companies is getting huge. So I don't believe anymore in you need a certain amount of equity in a company. Of course, I understand if they have like a limitation, but in the end, the potential of some companies is crazy high. And of the chances that they come to an IPO is of course super low. But if you look at these mega deals, I also don't believe that it makes so much sense to be fixed to, hey, we need like 15, 20% equity for this round.
I would agree with you. I don't think it's so smart to be fixed to those numbers either. And I do think that there's a little bit of a missing flexibility. If you want to, you can't compare America to Europe, right? You can't compare, you can't compare people, right? It's always about the individual. So there's a lot of absolutely kick-ass, fantastic European investors out there and American as well. But I think overall that the Americans are, from a cultural perspective, bigger risk takers. I think that they understand to some extent the necessity to stay in longer and to go in earlier, and that's what proves again and again. They understand that they need to be investing in category killers, and America has an advantage because they have the huge market, one big homogeneous market, so it's easier to see a category killer coming than perhaps it is in a fragmented European market. So there's a lot of aspects to it.
I actually did a post yesterday on LinkedIn, and it was also about self-made millionaires in the US versus Europe. And it's so interesting if you look at the numbers, because in the US, 75% are self-made millionaires. And if you compare them to Europe, the number is around 40%. And I mean, This is everything what you basically just summarized about being risk averse in my opinion, because the money here often transitions between families. And I sometimes have the feeling people don't want to take so much risk, maybe also because it's getting difficult and the upside is not that high. But this is definitely a huge difference from a mindset perspective between Europe and the US. So that might explain also the difference between the investor categories.
A lot of people ask me the question for decades now, or say to me, oh, America has no culture. And historically speaking, it's absolutely correct. Europe has thousands of years of culture. The America just celebrated 250-year birthday. Maybe it's 300 years of what we consider to be culture. But there is one culture that explains a lot in America, and that is that the United States was the new world. New is, by definition, culturally a good thing, right? If it's new, it's good. That explains so much about why startup works so well in the United States, because people in general believe, as a culture, we are the culture of the new in America. And in Europe, you have the more conservative in the sense of wanting to conserve what has been built over all the years, which has also its upsides. I mean, look, if I thought America was a better place to live, I'd be living there, and I've been here for 40 plus years. So, I'm certainly probably more German than I am American. But that culture of the new also has massive business ramifications and risk appetite ramifications. The American dream is, by definition, start your own company.
Yeah. We also need a European dream then.
I agree. And that's part of why I spent so much time, over 18 years building up startup programs. I just think that we now have to concentrate on our investors.
Before we speak about Venture University, and we briefly touched that already a couple of times, I have one last question, and it's more related to late stage financing. So in the US or in Canada, you have like pension funds, for example, and this is something where I see they often enter rounds when it's like a Series B or even more late stage. So we are, for example, quite well connected to Ontario Teacher, and they usually invest up to 40 million, but they don't go below that ticket size. And I was just wondering, do you think the concept of a pension fund, like these type of investor groups, are they missing in Europe? Is that also a reason why at some point you need to go to North America?
I mean, this is a really long and old discussion here. It is the case, that in many countries, pension funds are simply not allowed to invest in venture, which I think is a massive, massive mistake. And there's a lot of lobbying and there's a lot of discussion about we need to change that. Probably that more than anything else. The two things that I think would unlock venture, especially in Germany, would be allowing pension funds and insurance companies to invest in the asset class. And the other would be very strong tax incentives like they do have in France for private people to go into angel investing. There have been some angel investing support in Germany, but actually some of that's been cut back, unfortunately. So I think that allowing pension funds and insurance companies and such to invest ideally would be 2% of their capital in venture makes so much sense. Just like it makes so much sense for a family office to invest 2 to 5% in venture, right? Because venture is the only asset class which consistently invests, when they're doing it right, only in technology and companies that will transform the future of humanity, right? And therefore, they're the only asset class that consistently does perform at 20x and 200x on different investments. Overall, as an asset class, it's not performing that way, and we have to ask ourselves why. But it is the only one where if you put in 2% of your net worth and you lose it, you still have 98%. But it's the only 2% that might turn out to be 50% of your net worth in 5 years. So isn't that worth the risk? That thinking, I think we need to develop from the investor side.
That's very interesting. And I think now, since we started to speak about the investing side, I would like to speak a little bit more about venture partners and Venture University. Can you explain the concept and also like how these two things work together? How are they connected?
Yes. So Venture University is the education program that runs the Investor Accelerator. And the Investor Accelerator runs inside of our global VC fund. So we are a VC fund. That's called VU Venture Partners. We have about 80 million of committed capital, 60 million of that in a growing evergreen syndicate of about 8,000 investors, and 20 in Fund 1. And the name VU Venture Partners is very important because the fund itself is literally run by venture partners who apply every quarter to be accepted into the program. They pay a tuition, and then they are, from the very first day, full venture partners in the fund. They're able to go to every partner meeting, they drive deals, real due diligence, they run the due diligence, they take deals to investment committee, they come to every investment committee, even have a vote on their 10% of their tuition is invested in every deal, so they have a vote on the investment committee, and they leave the program after, the good ones stay a year, do 4 quarters. I did 4 quarters myself. I can tell you a little bit about the massive change for me as an investor that it created. But if you stay for a year, you've literally done 20 deals.
And when did you basically did the 4 quarters?
So I did. I found out about Venture University through my son Remy, who identified them in the United States. I was retiring from Deloitte Digital Ventures, which you were part of with me. We were the company builder unit there. And he asked me what I was going to do, and I retired. I said, investing in education. He said, would you like a partner? He had graduated this great CDTM program and spent a couple of years getting a startup going, which didn't go the way he wanted. And I said, I would love to spend the next couple of decades with you building something. And he identified Venture University. And I said, I need to do it myself. So I did 4 quarters. And just to give you an idea, and now we're the partners for Europe. But just to give you an idea, I did 55 angel investments in 2 angel funds that I set up starting in 2016. We had, on paper, looking great, but we were having trouble exiting. And I said, I need to learn why. And up till, 2021, we were fully invested by 2020, 2021. I had a nice exit. 22, 23, 2024, no exits. 2025, I did Venture University, 4 quarters. I had 6 exits.
Wow.
And I've had 2 this year already. Being inside of a VC fund day in, day out, listening in the partner meeting, listening to general partners who have 20 and 30 years of VC, who have invested in Facebook and early Uber investor, early Anthropic investors, made me realize I wasn't managing my portfolio in a way that was helping them to exit. And I also hadn't identified the fact that a lot of the companies I invested in, I never would have invested in if I had done Venture University first, because they didn't fit the criteria of a VC investment from the beginning. And I could have known that.
So can you tell us now what these criteria are?
I absolutely can. I mean, I obviously can't tell you everything you'll learn by being inside of a fund for,
of course.
And really this, like Venture University is the difference between reading a lot of great books about how to play tennis or getting on the court and hitting the ball with a racket. You don't have a racket in your hand, you have a checkbook, because if you drive a deal through to the investment committee and the investment committee votes to invest, then the fund and the syndicate invest. You don't need any money other than your tuition to drive, deals. We invest tickets between 200K and $1 million, so you have a real checkbook in your hand. And when do we say yes? Okay, so that's the question. What are the criteria?
Yeah.
The criteria are, in general, the biggest question is, how large is the magnitude of improvement to the status quo? So every problem is being solved at the moment.
Yeah.
The question is this solution to the problem 2 times better, 4 times better, 10 times better, or 1,000 times better? Right? Like, Uber was literally a complete transformation of the way you moved. Yeah, I mean, you didn't pay people.
Yeah.
Right? You could get them anytime. They came whenever you want. You had your own personal driver. Nobody had ever heard of this. Yeah. So, one example that Andrew Zalazin, one of our general partners, the second Sky Fernandez gives, he was the first 250K check into Venmo, which is like the biggest payment system now in the United States, sold for billions. When he invested in that, and this is the second criteria, is the market big enough? So is the transformation massive? So we look for 100x better, right? If it is massive, second criteria, is the market big enough that if you transform it, you will be a hugely valuable company? Because if not, why transform something that's not all that interesting? So really deeply understanding market size is something that I hadn't really understood properly.
Founders often also don't understand it. So if you see like these typical top-down calculations, and some of them, they always come to a conclusion that their market size is like over 1 billion or something, and it's just not true. So so I think it's important as an investor to, of course, do the due diligence and do like a proper market size calculation if the founder is failing on that.
I think you're absolutely right, and sometimes the market calculation is right. But that brings to the third question, which is the most important thing to really understand. What is your marketing hack? What is your entry what is your unfair market advantage, entry advantage? So in that example I was saying with Venmo, when Andrew invested, there were probably 100 payment transfer companies. What was their marketing hack was they were the first company that said, if you want to transfer money, all you need is a mobile phone number. Do you have one of those? And of course, everybody had one, and that drove traction completely through the roof. And so it was a complete change in the way people were transferring money, and they became a huge hit. We just invested in a company, a healthcare company in fertilization that is using AI to identify which eggs are more likely in the in vitro process to be successful. Just so you understand, from the market size, a 1 to 2% improvement in vitro results makes a company a unicorn. This company that we invested in is already showing 75% in horses, wow. Right? 75%, and is projecting in humans probably above 5. But what's the marketing hack? The marketing hack is that the largest network of in vitro clinics worldwide is an investor in the company. And they have already committed that if it goes well, they will roll it out across their entire network. So that's a market entry connection that nobody else would have, right? Yep. So those are kind of like, in a quick and dirty, what we look for, right? And I wasn't looking for that. I didn't know that.
That's super cool. And it also reminds me again of a marketing hack or like a strategy I just saw recently. So when I booked actually this studio, I think I paid via Revolut. And they also have like a checkout for businesses. And then they offered me in the payment field to get like a $50 discount, which I think is quite a lot, if I basically open up my own Revolut konto. And I mean, they use their own users to distribute you further and further. And I think if you have these strategies, it's like a flywheel and it helps you to grow extremely fast. So these 3 criteria are basically now what you use at Venture University and Venture Partners.
This is what we use. This is what we teach. Obviously, there is a full week of a master class that you attend, and so you learn Harvard level A to Z, what is venture. I did that class 4 times. The more you know, the more you learn. It's, I think, also especially interesting right now, if you think about who are the great investors, a lot of them are the post-exit entrepreneurs. People who have made it, are self-made millionaires, have figured it out. Those people start investing a lot of money when they exit. We're targeting them very much so because they're going to be investing a lot of money. And if they would do a 1-year investment, and we're only talking about a couple hours a week, that you have to spend to really do it. But, if you invest that kind of time in yourself first, in genuinely understanding what you're doing and you're inside of it, you're really doing investments. And of course you have a chance to invest next to us. We're also in an investment club in that way. You can invest in any deal starting at $5,000. And we don't just do early stage. Our alumni are incentivized. We now have over 1,000 alumni. And in Europe, we're about 80 right now in the 2 years, not quite 2 years that we've been running it here. And we're about to crack 100, I would say, by the end of the year. All those people are incentivized to bring deals. If you bring us a deal, you share in our profit of doing that. So we get into great deals. We invested 1.5 years ago in OpenAI. We invested 1.5 years ago in SpaceX.
And I mean, like, Venture Partners is like a big brand. Like, I think everyone knows Venture Partners at this point.
I think VU Venture Partners is a brand in the US. I think it needs a little bit of more time in Europe, but I appreciate you helping me to get the word out.
Yeah, and also now if we think about our listeners and the audience who is watching this podcast right now, we have a lot of people who building startups, who are investing in startups, who are just part of the capital markets. Now, who would you say is the perfect fit to apply to become part of a cohort at Venture University?
So I would say there's a couple different groups. There's a younger group in every cohort that are 20, usually early 20s to mid 30s, who absolutely want to get into VC. don't have a track record. When a VC puts out a job application, they get 500 plus applicants. You really set yourself aside because you've done 25 deals, right? So we just had one of our graduates is now with a great German impact VC. Another one just told me yesterday that he and a partner just raised 45 million and are setting up their first fund. So nice. That's another group, people who are setting up funds. Yeah. And it's also interesting for entrepreneurs who are building their company, because when you join VU, you actually get an email from the fund. You're given 100 deals to look at. You join one of our verticals. When you're given 100 deals to look at and you're a startup, you have to look at 100 decks and you have to say no to 90 of them. And it becomes really clear that you have to say no to 90 because they're definitely not VC cases. It makes you think differently about your own deck. Am I fundable? We've had a number of young startups that have come in, done the program, decided not to raise money. Bootstrap for 2 or 3 years, raise money 3 years from now when you're a venture case and you have great traction. Save yourself 30% of the time of one of your founders for years wasting on raising money when you don't really understand how an investor thinks. Put yourself on that side, be an investor for a quarter or so. And then the other big group is these post-exit entrepreneurs and family offices, right? Angels who have exited, like myself. I sold my company, start doing a lot of angel investing, and probably, fishing in your own pond is a big mistake that people make. I invested everything only in German companies. Nothing wrong with that, but there's a lot of companies broader. We invest globally, so at least you have access to global deals. We also have 50 to 60 investors in every cohort. So if they each look at 80 to 100 deals, we look at almost 5,000 deals a quarter.
Wow.
That's 20,000 deals a year. It's like 10 times any other VC. And we're very, very picky. We have done 19 deals so far this year, but we're very active, but that's just a fraction of what we see.
And I was already part of at least a small part of the process, because I was part of one of the events where some of the people who were part of the current cohort presented some deals. And maybe this is also a good entry point for some people who are here in Munich. If you think you are one of these groups that Andy just mentioned, go and apply to go to one of these events, because I met very cool and interesting people there who are all part of the ecosystem. It was great. And we will, of course, also put all the details about Venture University and Venture Partners into the description of this podcast. So definitely check it out and reach out to Andy on LinkedIn. Now, we were not going to stop here. I still have a couple of more questions and we still have a little bit of more time. We briefly touched the process now, and you spoke about the criteria. So all of that totally makes sense and is super helpful. But could we speak about the process from A to Z a little bit more? Like, how do the deals come to you? And then what happens next? Like,
sure,
you have like a partner meeting, people prepare that.
Yeah, let me sort of take you through. The first week is the master class, 40 hours, all recorded if you miss anything. The second week is pure startup pitches. You watch the general partners with 20 and 30 years of experience interviewing startups. You then stay on the line everything's live online, doesn't matter where you're located. You stay on the line and you discuss, was it a pass or a no pass? And then you pick one of the verticals. So let's say that we have 6 verticals, about 10 people end up in each vertical. The way the week works is you're given the 100 deals, you're given the email address, you start reaching out to these companies. Once a week for about an hour, you meet with your group and everybody brings the best deals that they saw. So the funnel takes those, and then of the best, you pick the top 2. And then that's usually on a Thursday. And then on a Monday evening is the partner meeting. So European time, most of the meetings run 6 to 8, which is 9 a.m. California time. You join every partner meeting. You're invited, at least. You don't have to. We don't take roll. You're treated like a partner. But you show up at the partner meeting,
How many people are in these meetings then?
50 to 60.
Okay.
The whole cohort is invited, yeah. Most people don't come on screen, for people who are working or a lot of, young fathers and mothers are feeding their kids while they're doing. I'm not saying that you should, ignore your family. I'm a family first guy, but I'm just saying part of Venture University is learning how being a professional investor fits into your life, right? So it's very, very flexible. But at the partner meeting, you actually see people getting shot down, not being told they can't do the deal, just being told you didn't think about A, B, C. If you want to keep doing this deal, if you really believe in it, go ask these questions, talk to these clients, right? So you're pushed to do that, but you do the due diligence. And you have to imagine a lot of people are in their second or third or fourth cohort. They're helping the people who are just coming in, right? And then you eventually do the due diligence. You start taking deals to the investment committee. You're invited to every investment committee, even the ones you're not on. So you get to see what's passing the investment committee. You learn how to build a deck, actually. All of that is templates. All of this information is yours for the rest of your life. And what's really interesting is we now have in our database of over 1,000 people that have took it, 898 who did the investor accelerator. The others some do just a master class, just the first week. But 898 people in the database, you have access to all of them via email. So the emails are screened first before we send it out. We never spam our alumni, but you can reach out to people. You can see what they're qualified to do. You can see what territory they're based in.
That's amazing.
Yeah, we have alumni meetings every quarter. You can bring deals. You can ask people for expert witness, that kind of things. And that's part of what we're doing. You said the events were exciting. They are exciting because just like in the beginning when I was setting up the Entrepreneurship Center, we need to build a great community of investors. And that has to be startups, and that has to be post-exit entrepreneurs and family offices and, people who are, looking to break into the investment market. All those groups need to come together regularly so that serendipity can happen.
Yeah. I would still speak a little bit about your own investment as an angel investor. Do you still remember like an opportunity where you could have invested in, but you decided to pass on the deal that is still with you?
I can tell you a lot. And this was the wrong thinking. Flixbus started in my entrepreneurship center. Trade Republic started in my entrepreneurship center. Yeah. I coached Salonis when they were doing their first early pitches. And I didn't have a fund at that time. I didn't have the money. And by the time I had raised, had my exits and was able to really invest and put together these angel funds, I thought I was too late. They were already valued super high. Looking back on it, they weren't valued super high at all. Yeah, I could have, and I don't know what the numbers were, but I mean, any one of those companies, if you invested when they were worth 100 or 200 million, you made an incredible, incredible deal. So I think that's what I understood, is that the idea of being too late is only a question of return. Too late compared to what? Like, when you invest in a public company, are you too late? Look how late that is. And yet, look what would have happened if you would have invested in Microsoft. Look at what would have happened if you would have invested in Apple. So I think that the venture space, people have this idea that they're too late. But yeah, I can unfortunately list a lot of unicorns that I could have been in and I didn't.
Do you think it's too late to buy shares from SpaceX?
I have them because I invested through VU and we're in the lockup right now. I think space is at the very beginning right now. I think that people have understood what's going on, and SpaceX has transformed the way people think about it. They have built an entire industry. So I don't think it's too late. I mean, I think if you're going to go into investments like that, then you really need to say, I'm going to be in it for 5 years, 10 years. Like I wouldn't invest in Bitcoin for less than 5 years either, but I think that that's something that you're not too late on either, right? but I think it's very much a question of staying power. And venture is about staying power. That's what I was saying before. It's not that it's too late to invest. It's that are you going to be able to stay in? Because what I learned through my angel investments is when you don't have the money to continue to invest and something goes wrong in the company, you end up at the bottom of the waterfall, right? Because everybody who's put in money gets paid back first. The latest money gets paid back first. And sometimes there are things called liquidation preferences, where if a company's really in trouble, then somebody says, well, I'll give you $1 million, but the first 3 million that come out go all to me. So now if you sell the company for 3 million, it sounds like a great, maybe a great number to some people, but the early investors get nothing because all of that goes to the liquidation preference to the latest investor. So staying power is an important thing, whether you're investing in public markets, and I think Warren Buffett says the same thing. If you invest in a great company you believe in, just relax.
That's great advice. And we are now coming a little bit to an end. So I just have a more personal question now. If you would not do investing or teaching, what would you do in the moment?
Well, I am dedicated to family business. My wife is a filmmaker and is now releasing her second novel.
Wow.
So it's called Berlin. It's written in German. Her first novel, also in German, is called Chase. We're translating Chase into English right now. I work with my daughter, who is a graphic artist. Her name is Mirella Goldstein. She's a great graphic designer, so I'm helping her, and she's illustrating a couple children's books that my wife Irina and I wrote together. So I guess if I wasn't working and doing investing, I would be much more heavy into the creative side of things. But I have a belief, one of my philosophies is, if you want to get something done, give it to someone who has a lot to do. I feel very fortunate that I have a lot to do. So
that's super cool. And Andy, now my last question is more like general advice. If you look back now at your history and all your learnings you have made so far, what is like the one advice you would give to investors who want to invest, but also to startups who are maybe just getting started to raise their first institutional capital?
Well, to the startups, I would say most important, above all else, do something that you love. Because when what you love really sucks, and sometimes it will, you will not give up so easy. Yeah, it's good advice for marriage as well, by the way. Marry someone you really love. Yeah, and as far as investors go, understand the transformative capacity of the company you're investing in. Don't fall in love with the idea. Look for people who are totally committed, but do make sure that you understood the transformative ability, understand the size of the market, understand their ability to break into it, and then once you're in, stay in. Yeah? Go in early, stay late.
Amazing. Andy, thank you so much for joining this episode. You have one more thing to say?
I do have one more thing, because we have noticed in Germany people are not always so used to paying for education. We are starting a fellowship program right now. So especially for people who are in their early 20s to their 30s, if you are interested in being part of Venture University and the cost is an issue, we are putting together a fellowship which will be purely based on merit. And I'm hoping that the best and the brightest and the most excited will also reach out to us on that. Basically, people who can afford the program, we will match their tuition with scholarships. So I think that's going to also have a really positive effect in the market, and then the younger people will be working with those people as well. So it should be a real win-win.
That sounds amazing. So if you just heard that, definitely check it out. And Andy, thank you again so much for joining. It was really a pleasure, and I just want to say I learned so much from you during my time at Deloitte, and now you also taught me again new things in this podcast episode. So it was really a pleasure to have you here.
Yeah, I'm very proud to be here. Very proud of everything you've accomplished as well, Niclas. You're doing a great job, and thanks for having me.
Thank you.